Welcome to the show where you'll learn how to invest in mortgage notes, the savvy real estate investor's secret weapon to create cash flow without tenants and property acquisitions for pennies on the dollar. My name is Robert Haitha, founder of Fix Notes, and my mission is to make note investing ethical, profitable, and accessible for you. In every episode, we're democratizing the industry to put these powerful Wall Street assets into the hands of Main Street investors like you. So without further ado, let's get into this show where you're in good hands with my AI clone. Let's go. This program is for informational purposes only and should be independently verified before taking action. Risk and reward in note investing are always linked. If you want high returns, you need to be comfortable stepping into situations that come with uncertainty. The good news is, unlike gambling or speculation, risk in this business can be measured, priced, and managed, but only if you know what you're doing. Most investors enter this space because of the potential rewards. Cash flow without tenants, no toilets, no repairs, no late night emergencies. You're not a landlord, you're the bank, you hold the paper. And when the borrower pays, you collect. When they don't, you still hold the leverage. The returns can be excellent. Performing notes can deliver double-digit yields when purchased at a discount. And non-performing notes, if resolved correctly, can double your money in 12 to 24 months, sometimes faster. But those rewards only come if you navigate the risks. The biggest risk is simple. The borrower stops paying. In a performing note, that means a loss of income and a shift in strategy. In a non-performing note, it means the resolution will take longer and cost more than expected. You have to be ready for that shift. Next is legal risk. Especially in judicial states, the foreclosure process can drag on for months or years. If the borrower challenges the action, your legal fees can double. You need reserves. Rob recommends that at least 30% of your total capital is set aside for legal, servicing, and unexpected costs. So if you buy a $30,000 note, you should have $10,000 in reserve. Not just for peace of mind, but so you can execute without hesitation. Documentation issues are another risk. If the chain of title is broken or key documents are missing, you may not be able to enforce the loan. That turns your investment into a worthless piece of paper. You must confirm the presence of the original note, the mortgage or deed of trust, all assignments, and any allonge before you fund. Trust, but verify. Then there's collateral risk. You're not buying the property, but the property still matters. A vacant home in a declining neighborhood presents more risk than an owner-occupied home in a solid area. If taxes are unpaid, the municipality may foreclose. You might have to advance funds just to protect your position. Due diligence on the property is non-negotiable. You also have to consider borrower risk. Some borrowers are cooperative, some are hostile, some simply vanish. If you don't have a plan for borrower outreach, loss mitigation, or foreclosure, you're flying blind. Every note you buy should come with a strategy for how to engage the borrower and what to do if that fails. Market risk shows up in the form of liquidity. Notes are not liquid. You can't just sell them overnight. If you need to exit fast, you'll likely take a discount. That means you have to enter every deal with a plan to hold. If you do sell, it should be because the asset improved, not because you panicked. None of these risks are deal killers, but they are real. And if you ignore them, this business will punish you. On the other hand, if you take them seriously and build systems to manage them, notes can be one of the safest and most scalable investment vehicles available. You choose the paper, you choose the state, you choose the lien position. You decide what returns you want and what risks you're willing to take on. You're not guessing. You're underwriting. That's the difference between a note buyer and a gambler. The key is discipline. Investors who lose money in this space often do so because they skipped steps. They chased yield. They ignored the condition of the property. They didn't check the legal docs, or they didn't hold enough in reserve. Every one of those mistakes is preventable. You don't need to be perfect, but you do need to be methodical. Follow a checklist. Track your assumptions. Monitor the timeline. Document your process. The more deals you do, the more data you'll have. Over time, that data becomes your edge. This business rewards those who prepare. You can't eliminate all the risk, but you can contain it. And if you contain it, you can scale. In the next episode, we'll walk through how to set your investment criteria. If you don't know exactly what kind of note you're looking for, every deal will look tempting, and that's a fast way to get burned. Episode 14 is all about defining your buy box and sticking to it. Thanks for sticking around to the end, and thank you to my trusty Robot and the Fixed Notes team for putting together another episode. If you want to learn more and hang out with the real, not AI version of me, join our free school community at school.com/fixnotes. That's SKOOL.com/FIXNOTES. In the meantime, we'll see you in the next episode.